Willem, are we over or underpricing what central banks are likely to do?
Probably overpricing a little bit. We don't think we're going to have 5 interest rate hikes in the US, this year, because if indeed, as the Fed says, we are going to have some decline in inflation sometime during the second half of the year, they will be able to sort of take their foot off the pedal to some extent. On the ECB side, we don't particularly see, a rate hike in 2022, in part because wage pressure is less. Some of this inflation pressure came from tax hikes. That's behind us. And in terms of oil prices, obviously in Europe, quite a lot of the gasoline prices, taxes, rather than directly linked to oil prices.
Do you think equity markets have, though, priced in 4, even 5? Do you think we're at the point, we've seen a lot of, obviously, movement in equity markets, but do you think we've got to the point where we can start a bottoming process, that we now know what we think we're going to get from the Fed? We don't think we're going to go maybe 6 or 7, as Mark Cabana was talking about. We think we're going to go 4 or 5. Do you think we're there yet?
So on the equity market, what we really look at is the real yield. And you can see what is priced in, by comparing, for example, we were talking about it before, technology relative to the aggregate index. And when you look at that, basically almost the entire rise in the real yield is priced in that kind of rotation. So I think what you're seeing now is technical selling of people who, are excited by these types of stock, private investors, and who have, a big position there. And so the question is how much selling you still have to do there. We've been emphasizing that people need to balance their value versus their growth stocks and find opportunities in both rather than always migrating to those growth stocks.
Do you think, though, that this is now the time where that growth migration will have stopped, the rotation sticks, and we do see value renaissance taking shape in some form?
Well, value, the reason why we have value and growth is that obviously on the growth side, there are a lot of companies that have, very good business models that are positioned for the future, and those are the ones that we want to look for. 2022 is going to be about earnings delivery, and a lot of the companies in the growth area, can deliver on that. On the value side, we need to make sure that we don't fall in the trap of the value trap, I would say, with outdated business models that are not adapted to the digital revolution or to the sustainability revolution. So we want to have that balance. And the reason why we are comfortable with a balance between the two is that we think the Treasury yield, is going to go sideways, in that 1.5% to 2% range.
Year to date, the S&P is down by 7.5%. The DAX is down by 2.25%. The FTSE 100 is up by 2.5%. Does that outperformance continue?
No. So, because Europe is indeed a value market, US is a quality market and a growth market. And so, in particular, if you are worried still about, that inflation being sticky, you want to make sure that you own companies that can pass on the input costs to their customers. Those are the ones with the big margins and the solid market positions. We find a lot of those in the US. So that's the real reason why we invest in the US, not necessarily the geographical, the economic, aspect, because all of those companies are global, right? It's the character of the US market, that quality character that attracts us to it.
So, Willem, are you not concerned that we're starting to see the limits of that pricing power and that margins will be an issue going forward? There is some wage pressure, and I think that's what you're probably referring to. The question is how long that wage pressure, continues to, be extended. And what the bond market is telling you, and Chair Powell referred to this as well, is that the break-even expectations 5 years, 10 years from now are basically relatively well anchored, and that tells you that the market is saying that wage pressures are, a matter of, either a one-off or maybe 1 or 2 years, but not, sort of for a very long-term perspective. And I think as long as that doesn't become ingrained, that you will have, companies maintaining that margin power. And if wages increase, then automation will be a good play. And so it's one of the themes that we like.
How bumpy is the ride going to be? Please tell me it's not going to stay like this for the rest of the year, because January has been brutal.
Maybe not like this, but it is, volatility is our core case for 2022. It's a positive environment for stocks because you've got your earnings and you're still in the mid-cycle stage, but you have to brace for volatility, and that's because inflation is too high for comfort. We will only know in a while when it comes down. We think in the second half, even if the Fed goes gradually, as we do think they will do, the market is trying to
Calibrating.
put on, yes, is calibrating and is potentially not as, confident. And so therefore, diversification, looking for quality, resilience, using hedge funds to diversify, all of those elements are important.
So if we're in for more volatility, investors will have to ride it out. Is the Fed going to be able to ride it out without getting too uncomfortable? What's the strike price of the Fed put now?
Indeed, I do think that it's a fair discussion that is there in the market, that they're not immediately going to come to the help of the market if the market corrects somewhat. But indeed, they are focused on the data. They are going to be humble and nimble, as we heard yesterday, and that's going to guide them. And that's going to be the economic indicators of inflation, of growth. What is the labor market doing? When are the supply chains going to be solved? Rather than a certain level of the equity market.